Sorry, all you handsome and beautiful smiling faces. I just had to minimize you there. But so we're going to talk about underwriting the deal. Of course, the disclaimer. I am not an attorney. I'm not a CPA. I'm not a certified financial professional. I provide this information and it's my interpretation provided for informational, educational, entertainment purposes only. Please do not invest solely based on the contents of this presentation or what I might tell you. Always consult your professional advisor when contemplating investments and their associated risks. So the title was Underwriting the Deal. What are the 6 key factors involved? So I'm going to give you the main 6, and then I'm going to give you a bonus 7. I always like to try to over deliver. First one is get the financials. What are the financials? When you're first talking to a broker, this is sort of one of the hardest questions people have. First off, it's hard for them to talk to brokers, but when they do get a broker on the line, other than listening to the sales pitch that the broker likes to give, you've got to get a certain amount of information from the broker. You do want to get the offering memorandum and review it. Then you need to ask them for the current rent roll. I've had brokers send me rent rolls that were as much as almost 2 years old and expect me to make decisions based on that. And then you'll hear the term T12. What is the T12? Basically, it's just the income statement or what might be called the profit loss statement over the last 12 months. And you want to see it for 12 months because you want to be able to identify potential trends. If you get a 6-month or a 3-month income statement, it may not have the payment of taxes on there. It may not have any one-time payments, or it might show an abnormally high income for a particular month that isn't necessarily there in other months. So it could misstate and give a false impression of the performance of the property. So you want to get for at least 12 months, and if you can get 24, even better.
Good question, Dennis.
Yeah.
So 212 already has the rent information in it. So the idea behind the rent roll is to find the hidden treasure.
I'm sorry, what was the first part of that question?
So T12 already has the income information in it, right, about the property. So what is the main goal behind the rent roll? Because
to validate that what they're telling you in the T12 is correct.
Oh, okay. Okay.
A lot of times, especially on smaller properties, Nirav, they'll report their income on a cash basis. Here's the money I collected for the month, and therefore you're not. And you'll see a sample T12 here in a couple of pages, and I'll point out what some of the hidden things are, or things to look for if you're just looking at a cash-only collection. But that can hide a lot of sins on the property. So you want to get as much information as possible, and if they don't have it, then you need to know to ask questions and dig further.
Okay.
So the T12 is comprised of two parts: the income and the expenses. And you can see here, these are the kinds of things that you're going to generally see in the income portion of the T12. What is the overall gross potential rent? A lot of people just show collected rent, but the gross potential is what will the market pay? What's the going market rate? And then you have to subtract out vacancies. If your rents aren't as high as the market rent, that's a deduction from income. If you got to give away concessions, reduce rents or whatever, that's a deduction from income. And ultimately, then you get down to an adjusted gross income number, add back in if you're billing them for utilities, and if you're doing other incomes like fees, application fees, late fees, pet fees, you add that back in so you can get an overall gross income number. And that's the whole idea. You want to be able to see these kinds of things over a 12-month period so you can look at trends. Are rent collections going down? Are they going up? Is there a particularly high piece of income for 1 month that's going to overstate income for the property? Like, I don't know, a cable company payment to you, one-time payment, so that they can be the sole providers of cable to your complex, stuff like that.
Dennis, are these certified financial reports, or are they whatever the guy or gal wants to blow smoke at you with?
For this initial look, Don, they are basically the statements that come from hopefully their property management company. So they're not validated through a CPA. And that's why if you do go into due diligence on these properties, then you have to look at tax records and compare them back to these T12s.
I have a couple things to add. One thing I've found is that if a property is doing a lease up, they may offer concessions in the beginning. And the question is, at renewals, are the rents going up, or are they staying the same, or are they going back down? They need to offer concessions again, because if they do, then it's an artificial amount that they're saying they're getting for rent. And the other thing is that when you go into due diligence, you can ask for copies of leases to verify the information if it's a mom and pop.
You absolutely should, yeah, assuming that they have leases. You'll occasionally run across a property where they allow people to go month to month and you don't have a lease any longer, so.
Mhm.
And then you look at rent rolls, and people are sort of confused when you look at a rent roll, but let me just give you a quick sample of one here. Is this easy enough to read, or do I need to go to the actual rent roll? You guys tell me.
Well, why don't you do a screen maximize your screen?
Oh, okay, I'm sorry. How's that?
Better.
Better.
Okay, good. This is a rent roll basically to tell you what the apartment number is, what type of, 3-bedroom, 2-bath townhouse, 2-bedroom, 2-bath renovated, 2-bedroom, 2-bath original, basically. It'll give you the square footage, the market rent, the contracted rent in the lease, any other fees that are being charged. So this is generally what a rent and the lease duration. So this will typically be what you'll see on a rent roll. Information like this. It'll be a little bit different depending on the management company and how they track their leases.
And Dennis, what was that apartment status like? O and N and
Yeah, they'll have. In this particular case, I don't know what the OC and the N stand for. Let me see if it's here. Whoops. I didn't pull down N. There's a notice.
oh,
The
okay.
C is occupied.
C is current and occupied. OC is occupied, vacant but leased.
Got it. Yep.
This information will be at the bottom of the lease, and they'll run totals for market rent, how much they're actually renting for, what the possible gross income is, and stuff like that. So this is the kind of information you want to compare back to the income statement to make sure what's being reported is close to accurate to what you're seeing here. And if not, you need to start asking why and dig further. This is what a sample income statement will look like. This is just the income side. There'll be expenses just like this as well. I'm not going to show you that because that tends to go 3 or 4 pages. But you see the gross potential, loss lease, all those columns or categories that I mentioned earlier, other income. Instead of having a line for each one of these, if you're doing your initial assessment of a property, I like to just break it into, a few major categories and bucket all my income into those categories and bucket all my expenses into those categories. And you'll see those in a minute. But that way, then you can take a look at a property from an early look at a property and see if it's going to fit your parameters or not. And then either dig deeper or push it to the side and look for the next opportunity.
So Dennis, if you're looking at or exploring what I would call a distressed property, it seems to me that a distressed property owner is not going to be as mentally organized to prepare such a comprehensive spreadsheet as this, that you're going to get, if you get anything, it's going to be, let's say, inaccurate or disjointed or even fraudulent, maybe. I'm just wondering how accurate is the data that you're getting?
You always have to look at this kind of data, Don, with a certain bit of skepticism. And that's why when you go through due diligence, you got to verify all this. But a part of your larger concern there is is if there's a bad situation, is the owner going to hide it? And they're certainly going to try. And the broker's going to try to help them wherever he can without running afoul of the law. But if you've got a decent property management company that's trying their best, you're going to see things like what you see here. If you look where my arrow is, line 4317, down units. This is that property I was telling you about in Florida where they had the hurricane issue. And they're tracking their down units as a negative to income. So, you know, if people are professional and doing their job properly, while you still have to validate all the numbers, they're going to show you this kind of information because you're going to discover it anyway, assuming you do all the right things in due diligence. You know, so this property, not only are they showing down units, but they've got an even larger, excuse me, look over here on the right-hand side in the middle here. They got $175,000 in impact to income from down units and another $72,000 in empty units outside of that. So this owner wasn't afraid to disclose the situation. That doesn't mean that they've lowered their price a whole lot, but they weren't afraid to disclose the very kind of information that you would be concerned about them trying to hide. Now, that's not true for all owners though, Don. You're absolutely right. And especially if the owner is keeping the books instead of a property management company, they very much will try to hide this kind of stuff.
And what do you use to verify the data?
Taxes, bank statements. You know, if they're committing tax fraud and I can't discover it, then then possibly we have issues. But beyond that, you validate everything through the bank account and into their tax statements for the last couple of years.
How long does that due diligence process take?
Anywhere I've seen it go as fast as a week to as much as a month.
But you're getting it under contract first with assumed values, and then you're doing due diligence, and then your choice at that point is either call them on it and say, give me the real information and offer a new price, or back out of the deal, you know, under due diligence, depending on what you put in your offer for back out.
Yeah, exactly. And what some people will do is they've got to put down 1% sort of as a earnest money deposit, but they won't allow that money to go hard until they get all the information that they require to be able to do and perform 100% of the due diligence that they want to perform, which means you can walk away at any time with just the cost of doing business if you have to. And then that means the seller has to spend more time and resources to get someone else to come in and try to
You prove that their spreadsheet is inaccurate in order to get your 1% back.
Or if they don't give you the information that you think has to be out there, then you can walk because you didn't get all the information that you need.
So sorry for asking a dumb question, but let's say after you do your due diligence, the actual numbers and the numbers they present to you are the differences. I'm just going to make up a number, 0.25% difference, just to pick a number.
Yeah.
In your contract, you say if there's a variation of X% or greater, we can walk away. In other words, is there some allowance for error?
Yes, there is an allowance for error in the purchase and sale agreement. How you word it, it is up to you and your lawyer and what the other side will agree to. I've seen it be a lot less specific than that, Don, and still give the buyer an out. If for any reason at the end of due diligence, we decide that this is not the property for us kind of language, then we can walk. And that's fairly common.
At the buyer's discretion, basically.
At the buyer's discretion, that's correct.
Okay.
The only time where that becomes an issue is if someone wants to gamble and puts their earnest money deposit down hard on day one to try to convince the seller to pick me. Then the seller can put the screws to the buyer, not the other way around. But a lot of times, if you're talking 0.25% or something to that effect, that may not be enough to kill the deal, but it gives you a chance to go back and retrade, renegotiate, ask for allowances, whatever the case may be, or ask them to fix something. Like with this particular deal here, The first question I had was, all right, this owner is taking the insurance proceeds after 5 years of court cases. Is she going to fix up any of the units or provide any of that money to the buyer to allow them to start, the construction process? And the answer was no.
Just pocket the insurance.
What's that?
We'll just pocket the insurance.
Yeah, she's just going to pocket it, take whatever cash she can get for the building and leave. And so then that means, as a buyer, I have to be able to swallow this. What is it? It's over $500,000 in order to try to make this property work. And that really affects the returns to my investors. And this deal becomes very hard to do it anywhere close to what they're asking.
And I wanted to add, I've been looking at a number of deals, and I'll give you an example. Someone had a great deal in Texas and they were really excited about it, and they didn't get the deal. They weren't picked as a buyer. And the person went back to the seller and said, what was the deal? Why didn't you pick me? And he said, well, the other people put hard money cash down the first day.
Yep.
And so, it's a market now where it's a seller's market for multifamily. And I think one of the things you have to do going in is assess what's your acceptable risk going into this. What are you willing to do? And, I know that Dennis works with his underwriting to leave extra room in there. It's something you have to make a judgment call on. Like, I went to Florida and of 5 off-market deals, 4 were gone the first day because people are just putting cash down and accepting it.
Absolutely. And at that point, the seller doesn't care if it closes or not. They're going to pocket the earnest money and move on to the next one. And you figure 1% on a $20 million property, $200,000 for not doing much. That's pretty good. And none of that goes to the broker. So tip number 3, expenses. The spreadsheet that I showed you on the income is 3.5 pages long for expenses. And instead of trying to deal with all 3.5 pages of Excel spreadsheet, I just break it into these general categories. Can you break these categories into subcategories? Absolutely. And if you're looking to dig deeper after you decide you want to chase after this property, you will want to do that. But so what is it? 1, 2, 3, 4, 5, 6, 7, 8, 9 major categories of expenses to look at. And, just lump them together. So you're looking at about 6 or 7 numbers on the income side, 9 numbers on the expense side, and you're going to put those together. You're going to come up with, the profit for the property. But that's not all. When you're looking to underwrite a property, it's not just the income and expense, and does the rent roll sort of tie into that? But there's the buying of the property as well. What are your loan terms? Because now let's assume that your property is in the green. It's generating extra cash over and above expenses. You still got to be able to pay the loan off. You got to be able to pay for the loan. And the banks typically have a certain level of income they want to see in order for them to write the loan to you that's over and above the amount of loan. For instance, they call it the DSCR, or the debt service, forget the term now, something ratio, debt service constant ratio, or something to that effect. But in essence, the bank wants to see for every $1 in debt, you can earn $1.25 in income to pay for that debt. That's sort of their minimum right now. And in a lot of cases, it's even a little bit higher than that. You're going to want to decide how much money down, and your bank's sort of going to drive that. What's your overall down payment? It's not just the earnest money, but it's also, right now you're seeing a lot of 25 and 30% down unless the person is very experienced and has done a lot of loans with the different lenders. So you got to plan on 25 to 30% down to buy the property. You got to understand what interest rate is and how it impacts the value of your property, so that you can figure out what your overall payment is going to be, and whether there's going to be interest-only payments for any period of that loan or not as well. And then, are you going to amortize this over 25 years or 30? A lot of banks right now, especially for smaller loans, are looking at 25-year amortizations, which are going to make those monthly payments just a little bit higher, a little bit larger than if they were 30-year amortization loans. That doesn't mean that you're going to get all 25 or 30 years to pay it off. They're going to have a balloon somewhere in the 5 to 10 year range, 5, 7, or 10 years. although there's some 12-year balloons right now. But once you figure all of that out, then you can take that profit that your property's making, apply it to the loan, and are you still going to be profitable after you pay off the loan? But that's not all. Tip number 5, what kind of market are you in? I was looking at a property not too long ago. I'll even say it was in Macon, Georgia, and also another property in Memphis, Tennessee. The particular markets are rough markets to be in. Average vacancy is 89 or average occupancy is 89 or 90%. At a maximum, a bank will allow 15% vacancy at a maximum, but they really want to be at 10% vacancy or 90% occupancy when they issue the loan. And if the market average is that or a little less, you're going to have trouble getting a loan, or you're going to have to come in with more money to decrease the amount of the loan to the value of the property. What are market rents? We were looking at properties in Columbia, South Carolina, where we thought we could come in, do a value add, increase the value of the property and raise rents, only to find out that we weren't going to be able to raise the rents. None other of the properties within a 5-mile radius of our property was able to raise rents after doing the same thing. So then we had to, that property no longer worked for us because we couldn't get the rent bumps that we were looking for. Taxes is one that most people tend to forget to take a close look at. What are the overall taxes in the area? How do they calculate the taxes? Do you know the mill rates? Do you know what kind of value deductions they take as far as assessment values of the property? And how fast do they reassess the property? Do they do it on purchase? Do they have a prearranged schedule of every 2, 3, or 4 years that they reassess? And are you accounting for that in your overall evaluation of the property as to when that tax hit is going to happen? Because believe me, you're paying more than the current owner paid for that property. Your taxes are going to go up, and failing to account for that, you got to watch out. And insurance the same way. The current owner may not have enough insurance or adequate insurance. Or if something happens to your property, insurance companies underwrite to the property, like that property that I was talking about in Florida was hit by a hurricane. So there was a claim in the last 5 years on the property. Is that going to automatically jack up the rates for any new owner because that property has already suffered one catastrophic event relative to insurance? And on. So you can just go on and on like that. Know your property management. What is it going to cost for property management as a percentage? Depending on the size of the property, can be anywhere from 3% today up to 10%. And Bob, can tell you what they're doing with their property management company. So the numbers are going to be all over the map, and where you come in at is going to affect the value of the property. So, but a lot of this information, the market information, occupancy rates, taxes, what is an average repair cost or maintenance cost per unit, which are the general admin costs per unit, and on and on and on. Your property manager, if they know that market, is going to be able to tell you that. And you need to have a good, strong property manager who understands that market, if not really knows that property as well, even though they may not have ever managed that property before. And that's key. If you're going to be successful, one of the keys is having a good property management company as a partner on these deals, because they're going to make or break your operation of that property. And if they know the market, they can guide you into what you can expect on these expenses and what you can expect on rents, and whether you can actually achieve what you hope to achieve as far as returns.
Dennis, quick question. So around Monaco, Bucks, and Delco, I know when we buy and sell single families or duplex or triplex, there isn't any reassessment. But is that still holds true for multifamily in these areas?
What's that on the assessment? I'm sorry?
And so, like, whenever we buy or sell up to 4 units, because that's all experience I have right now.
Yeah.
There is no reassessment and there is no impact on the taxes. But is that still true for the larger deals, let's say 15 unit or 20 unit?
Not necessarily.
Okay.
And that's why you have to know your specific market, your specific county, because it can change within the state.
No, I'm talking about Monaco, Bucks, and Delco.
To be honest with you, since I haven't come close to buying anything in Monaco, Bucks, or Delco, I haven't gotten that answer, so I don't know. But
Okay.
it would be easy enough to find out just by calling the tax offices. for
Yeah,
you.
I think the answer is no, but I'm not positive. So I think I'll give them a call just to be on the safe side.
Yeah. Now that you're going to run into a situation too where, like Texas, and I think there's a couple of other states are non-reporting or non-disclosure states is the term, so that the dollar amount of the property that was sold isn't necessarily required to be reported to the state or the county. So then you're not going to be able to go back and find history on the property to see. So you're sort of going to have to do a little digging, but that's more the exception than the rule. Usually all those numbers are public domain, and you can get them and find out and make assessments. But you got to have a plan. If you're going to buy a property, you got to have a plan for how you're going to operate it. This is a business after all.
Yep.
And there are three main strategies. There's a lot of sub strategies within these, but there are three main strategies. One is if you're going to buy like a Class A or Class B cash flowing property and just buy and hold it, that's one strategy. Another one is where you can add value to it by doing improvements and hopefully raising rents. And then, or even what we would call a repositioning, which is almost doing a lot of new construction, like that one property in Florida. That's not value add. That runs into what we call repositioning. A lot of construction work. It's going to take more time. Probably be cash negative in the first year and a half. But that's all part of value add. And then, are you going to cash out and refi, or are you just going to sell? I didn't put sell on there. I should have in that third bullet. But you can either once you get through the construction period and you've done all your improvements to the property, you can either get a new loan for the higher value of the property, pay back your investors some or all of their initial investment, and then just have infinite or near infinite returns, for the whole period after that, or you can just sell at that point in time. So the question is, what is your objective relative to operating the property? How are you going to run the property? So you got to keep your investors in mind in doing that. And on the other side, you also have to be working with your property management company so they understand, how you want them to run it day by day, what kind of quality of service you want them to give to the tenants. And there's going to be a lot of metrics that you're going to hold your property management company to. All that is part of defining your plan for operating the property. And if you have a good plan, you should be able to achieve, all your objectives and make your investors or yourself happy if you're the sole investor. So here's the bonus item: how to establish your offer or establishing your offer. Once you've gone through and you've looked at the income and the expenses and all those other things that we just talked about, it really, at the end of the day, it comes down to what kind of return are you going to get on this effort? Because anytime you put money up for something, you've got to get a return on that money, or why do it? And so there are a lot of different returns to look at, or a lot of different metrics to look at that you may want to achieve to help your investors be happy. But really the two main ones are the cash on cash return and the average annual return. And those are two different things. The cash on cash, as you can see here, is free cash flow after loan payment divided by how much it costs to actually buy the property. And I don't mean purchase price. I'm talking the amount of money you actually put into it, which is the down payment, expenses to go through due diligence and legal fees and stuff like that, plus any escrows that the banks may require you to put up. So that's all cash up front. And that gives you a cash on cash return. And then you have go ahead.
What are you looking for on that?
Well, I was going to get to that in the second bullet, Don. So then you've got the average annual return, which just takes your cash flow plus equity gain over a certain number of years and averages that out. And that gives you a certain return as well, based on your initial investment. The question that Don asked, and I'm glad he asked it, he was ahead of me there, is that if you're going to syndicate, you got to know what your investors' expectations are. Because you're going to see a lot of people out there that are going to try to providing, because of how expensive multifamily is today, they're going to be looking at 8, 10, and 12% returns. And in today's market, frankly, those are good returns, But there's a lot of investors that aren't necessarily going to be happy with that kind of a return. At least not right now. Maybe in a while, who knows? If your investors are okay with that, then you can go after those kind of properties. If your investors are looking for 15, 17, 20% returns or higher, then you're going to have to find properties that'll provide those level returns. Of course, the lower the return, the lower the risk, the higher the return, the higher the risk on the property. So it depends. If you go back to what your strategy is, what's your plan? If you're doing a buy and hold, the returns are going to be low double digits to high single digits. If you're doing mild to moderate value adds, they're going to be in the low double digits, and I'm talking 10, 12, 13%. If you're going to do a very heavy value add or a repositioning, you can see returns of 25, 30, 35% annualized, over the hold period or until you cash out and refi. So it depends on what strategy you use as to what kind of returns you can reasonably expect, and you have to have the right investors involved depending on the type of properties that you're looking at.
Do you integrate the depreciation as part of the return to the investor?
No, that's a bonus, because that number changes. While the depreciation amount on the property doesn't, the impact to the investor, it does. So they need to look at that. We can tell them what generally the depreciation is going to be. If we're taking an accelerated depreciation, we can give a benchmark of what we think that's going to be. Then it's up to each investor to determine how that's going to impact them and how much more that's going to increase their returns.
Right, but you can say you'll get X dollars per $100,000 investment per
Yeah.
year.
Yeah, although once you sell it, you recapture that depreciation. So
At a different tax rate.
yeah. Well, the tax rate is personalized, but
Well, the depreciation is your short-term tax rate, and the when you do it, you get the short-term capital or the long-term capital gains rate.
yes. So then when you're looking at, all right, so now you've gone through all of this, you've got everything lined up, the stars, the moon, and the sun all align. You found your unicorn like we did with, say, Canongate. You determine what your strike price is, the amount that you cannot go over. That is your hard upper line limit as far as what price you can accept based on all the other information we just talked about. And that you can't buy the property for more than that. But you don't want to offer that right off the bat, because they're going to take that as the starting point. You can only use that as the finishing point. So you need to then determine your initial offer, which is going to be below your strike price. The key here is to know your number, stick to your numbers. If you're really trying to fudge it at the end of the day, to try to make it work to where maybe I can go a few $100,000 higher and it'll still sort of kind of work if everything aligns right. That's when you're risking other people's money needlessly. Don't do it. Move on to the next one. And in today's environment, I know that's hard. You have to, where you used to have to look at 4 properties to find a potential deal. Now you may have to look at 20 or 30 to find a potential deal, or even more, because everyone has jumped into the game. And we're seeing a lot of crazy prices and people taking a lot of crazy risks just so they can say that they are a multifamily property owner. So you want to be careful. It's not, if it's just your money, take all the risks you want. But if you're using other people's money, from my perspective, there's an expectation of some kind of fiduciary responsibility to not expose my investors to undue risk unless it's fully disclosed and they're fully on board with it, and then go from there.
What's your experience with Class C, Class B, Class A properties? In other words, would you start in a Class C and improve it to a Class B, or start with a Class C, or let's start with a B and improve it to an A, or what's your experience with that?
Good question. Let me stop the share for a minute here so I can see everybody. Here we go. Did I stop share properly?
Yeah,
Okay, good. Don, that's a good question, and it sort of has a lot of different angles to it. The idea is if you can find a C property in a B neighborhood and upgrade it to a B, that's ideal, right? But it's not going to be cheap because if it's a C property, it's usually a 1970s vintage or earlier property. And you know you're going to have to replace major plumbing all the way out to the street, to the city provided connections. You're going to have potentially major electric issues, so you may have to open up all the walls and rerun potentially new wiring. You're going to have parking lots and roofs and other things with the building that are going to be potentially problematic, and there's other issues. So while it's not cheap, you can do it, and it can be very fruitful. And if you can do a B and get it up to a B plus, then you want to be able to do that as well, as long as the neighborhood supports it. What we've been seeing is a bunch of people buying C assets because they're cheaper, but they're in C and C minus neighborhoods, and they're over improving for the neighborhood and not able to get the returns that they would like to get, simply because they over improve the property. Sort of what you're seeing potentially in house flipping as well. People are buying old properties and they're putting in marble and all kinds of fancy stuff because it looks good, but then they can't get the value for the property that they originally projected. So the same is true in multifamily. You just have to be careful with it. And that's where knowing the neighborhoods and knowing what the trends are and knowing the growth patterns are all factor into that decision.
so far, we've talked about traditional apartment living, whether it's a B or a C or an A, is a
Yes.
nuance to that. But there are other kinds of multi-unit living patterns. For example, retirement living or healthcare living, or I'm just mentioning a couple of them. Have you looked at those other, I guess, living environments, and what are the economics, and how does it compare to the traditional renter, single family, multi-unit family renter?
Yeah, I've looked at several times. I've looked at some student housing. I have not looked very deeply into senior facilities because that isn't just a real estate play, but it's also a care play, and it gets involved with a lot of the medical side of things and stocking a cafeteria and having social activities for your residents. And there's more to it than I've really taken the time to try to look into. There's also hotel conversions. I haven't looked into conversions too much because of the permitting process and the cost of construction lately, although there's a lot of people jumping into it. So I don't have a lot of knowledge in those areas other than outside of conventional multifamily. I have looked at a number of student housing properties.
Well, depending on the location, I would imagine you could convert some of the units into an Airbnb model rather than your monthly or annual lease model. Is that possible? Have you looked into that?
You can, to the extent that the bank will let you do that. They don't typically like to lend without having leases in place to be able to validate a specific occupancy percentage.
And from personal experience, I can tell that most of the towns will not allow that.
We did a workshop on Airbnb before the pandemic, and some banks are perfectly happy lending to an Airbnb.
No, I'm talking about a township.
If they under-
Yeah, the township, like legal use of that building probably will not fall under that area, because I had got bitten by that once.
Yeah, Don, what I would say is if you're looking at, say, 100 unit property and you're going to buy it with the hopes of making it all Airbnb.
Maybe 20% or 10%.
Well, so what I would suggest there is you have enough leases that makes the bank happy to go ahead and write the loan. And then over time, you can turn more and more of those as people leave. You can turn more of those into Airbnb as long as that works financially.
I'm just thinking of ways to maximize the rent roll, so to speak.
Yep,
Yeah, but
exactly,
I think
because you can get more money on a per night basis potentially, right?
but I think the Airbnb, the management costs rise to 20, maybe 20+%, because the whole turnaround and like the cleaning and like the issues that they create and comes up. Like, because I have a few of my Airbnb of my own, so that's why I'm just sharing this detail.
Right,
Yeah, that's always a consideration that you have to model out, right?
Yep.
But if it models out, then the only holdup is finding the right bank that's understanding enough, or creating a situation after you own the property to get to that point, and that would be part of your business plan.
I was just wondering what your personal experience was at these alternative rent roll models.
Yeah, I haven't gone too deep outside of the more traditional look, except for student housing.
And how did that pencil out?
It can work. Again, it's a little bit higher on the expenses, and you have to have a different kind of a lease. And your approach, your business plan has to be a little bit different because the students aren't always there. But I did make several offers on student housing properties prior to the pandemic, and was looking to get close to going under contract on one just as the pandemic hit, and then pulled out because they started shutting down the schools. And
Wise move.
yeah, exactly. It wasn't due to any skill on my part. It just was fortuitous. But
Dennis, isn't the lending different also on student housing?
yeah, a little bit.
Yeah.
But that's the extent of my outside of the more traditional approach, Don.
Thank you.
I know a friend of mine who went after a property and had a couple of Airbnbs in it. He didn't think it was a problem. But then when he went to the lender shot it down because they considered the Airbnbs vacancies. And his vacancy rate was too high.
Right, you need to find a lender who understands hotel lending,
Yes.
because an Airbnb is closer to a hotel model rather than a residential model.
And if you have experience in the hotel model, and if you find the right lender, and you account for all the other differences, I don't know what all the lending requirements would be on that. I'm sure they're different than the standard multifamily model.
Well, Marriott figured it out a while ago.
What's that?
Marriott figured that out a while ago.
Okay. So it can be done if, but I've sort of tended to focus in the more traditional mainstream side of it. But there's a lot of people making a lot of money in that area. So. Any other questions or let me